Welcome back to the Deep Dive. We're here to cut through the noise and figure out what the data is actually telling us. And today, well, we've got a real head-scratcher on our hands, a classic financial paradox. How can Bitcoin's fundamental value, like the real money invested, hit a new all-time high, a staggering $1.1 trillion? While the price just seems, I don't know, stuck, barely holding $110,000. And, everyone still feels shaky after that recent $19 billion crash. Scary surface, solid underneath.
That's exactly the puzzle we're tackling. Let's maybe ignore the price tickers for just a bit and really dig into the on-chain stuff. Our sources are showing this split picture. Huge amounts of capital quietly flowing in, accumulation.
Yeah.
But it's happening right when the big, loud institutional buyers, the ones who move markets fast, seem to hit pause.
Yeah.
And to really get the strength we're seeing, you got to shift focus from the market cap that's just price times supply, right? It changes constantly, like painting your house a different color every day. We need to look at the realized cap. That's the key metric here.
Okay, realized cap. That's the one showing real conviction, isn't it? Break down how that works for everyone listening.
Absolutely. So the realized cap, it basically values each Bitcoin based on the price when it last moved on the blockchain. So if you bought Bitcoin 5 years ago at, say, $10,000, your coin counts as $10,000 in this calculation, not today's price. It tracks the actual cost basis of the network, the real money people put in and haven't, panic sold. It's the foundation, not just the paint job.
Yeah, the foundation. And that foundation just got, what, $8 billion thicker? That's huge. An $8 billion jump in invested capital, pushing the realized cap to $1.1 trillion, all-time high. So the money's definitely there. Why isn't it moving the price needle? Where's the disconnect?
Okay, let's unpack that. Because this is where the market structure gets really interesting. We're seeing data from CryptoQuant, for instance, that confirms, despite all the negative feelings, the fear, the fear and greed index is still way down in fear territory after that October dip. Despite all that, long-term holders and miners, they're buying, they're accumulating, aggressively even. They bought that dip.
So, okay, demand is there, but it's like a slow simmer, not a boil. If $8 billion flows in, shouldn't we see something? Why no big price reaction?
Well, it comes down to where that capital is coming from. And maybe more importantly, which taps have been turned off, Ki-Young Ju, the CEO of CryptoQuant, he nailed it. He said the recovery is, and I quote, missing its two biggest engines.
The big engines.
Yeah.
He means the institutional fire hoses, right? ETFs and MicroStrategy.
Exactly. Think about the last year or so. Since early 2024, those U.S. spot ETFs, they were the main channel for big money, billions and billions poured in. But lately, those flows have really slowed down dramatically.
Yeah, and we should look at why. Sources are pointing to October, where those ETFs actually saw net outflows. Money leaving. Now, that wasn't necessarily institutions losing faith long term.
Yeah.
It seemed more tied to global stuff, geopolitical jitters making big funds nervous. So they pull back from anything seen as risky, park money in cash or treasuries. That just sucks the immediate buying pressure out of the market.
Precisely. That pause starves the market of that instant liquidity. And then there's the second engine, the big whale of corporate buyers. MicroStrategy, Michael Saylor's company. They hold, what is it now, around 640,000 Bitcoin. That's like 3.1% of all Bitcoin. For years, they were just relentlessly buying, consistent, predictable demand. But now, sources confirm they've paused the major buys. The reason given is a balance sheet recalibration.
Recalibration, interesting term.
Yeah, so when arguably the single biggest, most consistent corporate buyer steps back, even temporarily, the market loses that immediate upward push. It doesn't matter how much quiet accumulation's happening underneath from miners or retail.
Okay, but let's push back on that a little. Recalibration. Could that just mean they've hit some internal limit? Or maybe they're holding out for a better price, it feels like. Maybe there's more to it. Ki-Young Ju's quote seems critical here. Demand is now driven mostly by ETFs and MicroStrategy, both slowing buys recently. If these two channels recover, market momentum likely returns.
Right.
So the problem he's highlighting is this reliance on these huge, less frequent institutional bursts to really move the price. That $8 billion realized cap surge proves the conviction is there, the long-term belief. But without that daily fire hose from the ETFs, the rally just stalls out.
That's the key insight, I think. The foundation is getting stronger, built by these conviction buyers who don't care about the daily noise.
Right.
But they don't provide the velocity, the speed of money needed for those sharp upward moves. That comes from the big ETF flows.
Let's zoom out for a second. Look at the bigger picture here. Ki-Young Ju calls Bitcoin a money vessel.
A money vessel. I like that. Yeah, it's like this expanding container designed to capture capital that's moving towards hard digital assets. And that vessel, it's clearly getting bigger, stronger, regardless of the short-term waves or who's currently taking a break from pouring water in.
And the evidence for that long-term conviction? Beyond the realized cap, you see it clearly with the miners, don't you? They are thinking day to day.
Not at all. Look at the hash rate, the network's computing power. It's soaring. That signals huge long-term confidence. Miners are expanding their operations like crazy at speeds we usually only see just before a major bull run kicks off. Their models must be showing serious long-term profitability.
And this isn't just clicking buy on an exchange screen. This is serious capital investment, physical infrastructure. Like that example our source mentioned, American Bitcoin buying, was it over 17,000 new mining rigs? Worth over $300 million back in August? That's a massive bet.
Exactly. You don't spend that kind of money unless you believe the network's value, and therefore the price is going significantly higher over the long haul. It really shows how the market's maturing. We're past pure speculation now. It's becoming the structured accumulation phase built on maybe 3 key pillars of demand.
Okay, let's break down that structure. Makes it easier to grasp the different forces at play.
Right, this 3-pillar demand structure. So pillar 1, ETFs. They provide the easy on-ramp, the liquidity for huge regulated institutions, access. Pillar 2, corporate treasuries, think MicroStrategy. They represent conviction, yes, but also scarcity. They lock up huge chunks of supply, taking it off the market.
Scarcity's key there.
Definitely. And pillar 3, miners. They're the bedrock, ensuring network growth, security, sustainability through constant investment in hardware. All 3 are vital, but right now, that first pillar, the liquidity and access one, it's kind of dormant. And that explains why the price feels capped, even with a strong foundation.
That makes a lot of sense. Great structure, strong foundation. But the engine's idling. So the big question is, when does someone hit the gas? Let's look ahead. What could actually trigger that breakout? Turn that $1.1 trillion realized cap into, real price momentum.
Well, analysts like those at Bitfinex, they're looking at a potential path to maybe $140,000 by November. That's their base case.
$140K by November.
Wow.
Wow. But there's a catch.
Oh, yeah, a big one. That forecast really depends heavily on those 2 missing engines firing up again. They need 2 specific things to happen, basically at the same time. First, ETF inflows need to seriously rebound. We're talking maybe $10 billion, $15 million in new money flowing in globally. And second, this is the big macro piece the Federal Reserve needs to start easing. They need to cut interest rates probably twice in the last quarter of the year.
The Fed. Always the elephant in the room. Why are rate cuts such a huge catalyst? Walk through that chain reaction. If the Fed cuts rates, how does that money find its way into Bitcoin ETFs?
Okay, so when rates are high, like they have been, just holding cash or safe government bonds gives you a decent return. Risk-free, basically. So, big institutions, they're happy to sit on cash or bonds. Why take risks? That drains liquidity from other assets.
The liquidity drain.
Right, exactly. But when the Fed starts cutting rates, those safe returns vanish. Suddenly, institutions have all this cash earning next to nothing. They have to put that money to work somewhere else to meet their goals. And Bitcoin, especially through those now established ETFs, looks pretty attractive as a place to deploy some of that capital, particularly if it's been trading flat while its fundamentals got stronger.
So lower rates basically flip the incentive switch for trillions of dollars globally.
Precisely.
We did see some calming on the macro front recently, like that Trump-Xi trade deal announcement. That helped sentiment a bit.
Yeah, stability helps.
But it's the actual policy change, the Fed actually cutting rates, that really opens the floodgates for liquidity to potentially rush back into assets like Bitcoin via the ETFs.
That's the key unlock.
So when you put it all together, it looks like, well, almost a textbook pre-bull setup, doesn't it? You've got weak sentiment, the fear and greed index is low, people are still nervous from the crash.
Yeah.
But underneath, the fundamentals, like that $8 billion realized cap jump, are just screaming strength.
Yeah.
Historically, isn't that when the biggest rallies tend to start? When the foundation's rock solid, but everyone on the surface is scared.
It's a classic pattern. The smart money, the conviction money is already in place, locked in. But the policy environment and the biggest players are just waiting for the signal, the green light, before they pour in the volume needed for the next leg up. It really highlights this unprecedented institutional patience. The capital is there, committed in the realized cap, but the main triggers, ETFs and MicroStrategy, are paused, waiting for the macro stars to align.
It definitely feels like a very strong foundation is being laid. Could be setting up for a major cycle, maybe looking further out into 2026 if this quiet accumulation keeps up. The vessel's filling, like you said, the engine's built, just waiting for someone to turn the key, and it sounds like the Fed holds that key right now.
Seems that way.
Which leaves us with a final thought to chew on. If MicroStrategy and the big ETFs are kind of on pause, waiting for cues, what other sources of demand might step up in the meantime? Could we see, I don't know, smaller institutions, maybe pension funds or even sovereign wealth funds starting to dip their toes in more seriously? Could they be the ones driving the next phase of demand for the money vessel while the giants recalibrate?
That's the multi-billion-dollar question for the next few months, isn't it? Who steers the ship next? And look, if you found this discussion on the realized cap and the 3 pillars useful,
Yeah, let us know.
definitely. Engaging with the video, subscribing, commenting, liking it genuinely helps us out. It tells the algorithm people find this valuable and lets us keep digging deep like this.
Absolutely. We appreciate the support. Until next time, keep analyzing that data.